Hey everyone, let's clear up some confusion about mortgage rates. By now, you've heard that the Fed cut rates on September 18th at 0.5%. Unfortunately, there is a lot of misinformation going on where people are using this like a mathematical equation and deducting 0.5% from mortgage rates. And that's not how this works. I've got an apple and an orange here. While they are both fruits, they are not the same. That is the same thing with the Fed funds rate and mortgage rates. They're both interest rates, but they're not the same. So when the Fed is cutting a rate, that is going to be your car loan, your credit cards, your personal loans, business loans, those types of things. That is a direct impact from a Fed funds rate. But when you get to mortgage rate, it has an indirect impact on it. So what does that mean? In my 30 years in the industry, there have actually been times where a Fed funds rate cut has been bad for mortgage rate because they can lead to inflation. But this time around, the Fed cut rates because they believe inflation is under control. And that is the key driver for long-term interest rates, like mortgage rates. So where are we now? We are at the beginning of a trend of lower interest rates. Forecasts suggest that inflation will keep easing, which is good for mortgage rates. Rising unemployment, also good for mortgage rates. And if the Fed's concern about a possible recession pans out, that's another factor that could cause mortgage rates to go lower. Bottom line, mortgage rates are on a downward trend, but it is not going to be a straight line. So if you have questions about a Fed funds rate and mortgage rates and how they tie together and how they differ, let's chat.